Have you ever looked around and felt like something is off, but you can't quite tell what it is? That strange silence before a storm, when everything seems normal but the air feels heavier than usual. That's exactly where the United States is right now. Something has happened. A shift. A quiet one, almost invisible at first glance, but powerful enough to change the course of the economy. And the most unsettling part is that almost no one is prepared for it. So stay until the end to see what's just happened, leave a like, and let's start. On paper, the story looks good. The stock market is soaring to new heights. Headlines are celebrating another year of strong returns. The economy, they say, is resilient. But beneath that smooth surface, numbers are whispering a different truth. One that history has told before. Many times, just before everything turned upside down. To see it clearly, you have to start with something small. Something that doesn't make noise, doesn't catch attention, but has always signalled what comes next. The unemployment rate. It sounds boring, it sounds technical, but it has been the quiet messenger before every crisis. In 2007, it rose by just 0.5%. People barely noticed. Then, within a year, the financial world collapsed. In 2000, it did the same thing, up by 0.5%, right before the 2001 recession began. Now, today, that same pattern is repeating. Over the past year and a half, the unemployment rate has ticked up by 0.5%. It seems tiny, insignificant, but if you look back over 6 decades of data, that small rise has almost always marked the moment when calm turns into crisis. And yet, what is the market doing? Breaking records. Investors are cheering, celebrating, chasing momentum. It's almost identical to October 2007, when optimism drowned out logic, when people believed the worst was over, when the system was quietly cracking beneath their feet. Back then, the market hit a new all-time high, while unemployment crept up, just like now. Then the collapse came, wiping out more than half of the market's value. The same signs are flashing again, but this time, there's a dangerous difference. People don't want to see them. The Federal Reserve has kept interest rates at the highest level since 2008. Borrowing costs have climbed for everyone. For families, for businesses, for the government itself. Credit is tightening. The economy is slowing. And yet the illusion of growth continues because the surface still shines. But when you dig deeper, the data reveals something else entirely. For the past 3 years, the index of leading economic indicators, one of the most accurate predictors of recessions, has been sliding down month after month. The last time it behaved like this was before the recessions of 2001 and 2008. It's not a theory, it's a pattern that repeats itself like the rhythm of a storm forming far away, but moving closer every day. Meanwhile, job growth has nearly stalled. The government's own reports, the non-farm payroll data, show that hiring has slowed dramatically. The engine that once powered the labour market is losing steam. If it dips just a little lower, if it falls into negative territory, that's when contraction begins. And once job losses start spreading, confidence evaporates fast. All of these quiet shifts have been building for months, but the final trigger, what just happened, is something bigger than any single number. It's the return of a force that has destabilised economies time and time again, a global economic shock disguised as policy. This time it came through tariffs. At first glance, tariffs sound harmless. Just taxes on imported goods, right? A way to protect domestic industries, balance trade, maybe even bring manufacturing home. But the real effect is far more dangerous because tariffs ripple through the system like invisible waves. They don't just affect one product or one company. They touch everything. The cost of materials, the price of food, the availability of parts, the speed of trade. They turn certainty into hesitation, and hesitation into slowdown. And that's exactly what has begun. Over the past months, new rounds of tariffs have been imposed, adjusted, or threatened. The result? Businesses across the world, and especially in the United States, have been thrown into confusion. Supply chains that were already fragile are now tangled again. Prices are climbing, deals are delayed, hiring plans are frozen. Just a little break, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below, back to before. If you look back at history, you'll see how these external shocks tend to trigger downturns. The 1970s had oil shocks, Prices spiked, costs soared, and recessions followed. The early 1980s, another oil crisis. The 1990 recession, again tied to oil. Even the tech crash in 2001 and the housing collapse in 2008 were preceded by surges in energy prices that helped push the system over the edge. The pattern is unmistakable. When energy or trade costs rise too quickly, economies stumble. Oil in particular has always been the heartbeat of growth. When its price jumps, everything else follows. Over the last 70 years, with only one exception, the pandemic, every major US recession was preceded by a spike in oil prices. On average, oil rose about 150% in the lead up to each downturn. That kind of surge acts like the most brutal tax imaginable. It raises transportation costs, production costs, and everyday expenses. It squeezes families and businesses at the same time. It doesn't matter how much you earn or what you buy, higher energy costs make everything harder. Now, tariffs may not seem as dramatic as an oil shock, but they hit the economy in a surprisingly similar way. They raise costs, limit choices, and disrupt flows of goods and money. Research from the European Central Bank and the Federal Reserve shows that a 100% rise in oil prices typically reduces GDP by about 5%. Given that most oil spikes before recessions are closer to 150%, that's a 7.5% hit to growth, enough to pull an entire economy into contraction. Studies from Yale University and the World Bank estimate that broad tariffs can cause a 2.5% to 3% reduction in GDP. On paper, that looks smaller. But unlike oil, tariffs don't just hurt financially. They create uncertainty, and uncertainty multiplies. When oil prices rise, companies can calculate the new cost. They can adapt. But when tariffs change suddenly, no one knows what next month will look like. Will the next shipment be taxed at 10%, 20%, or 100%? Will a deal with another country collapse overnight? That fear stops companies from hiring, stops investors from spending, and stops trade from flowing. Earlier this year, right after the latest wave of tariff announcements, markets shook. The S&P 500 dropped by 20% in just a few weeks. It wasn't because profits vanished overnight. It was because fear did what numbers couldn't. Investors panicked. The system froze. That panic could easily have turned into a full-blown recession if uncertainty had stayed high. But once the initial shock faded, once trade negotiations with key countries like China and India showed signs of progress, optimism returned. Markets bounced back. Investors convinced themselves that the storm had passed. And yet what we're seeing now isn't real recovery. It's complacency. The danger didn't disappear. It just went quiet. Corporate America looks strong on the surface. Profits are high, balance sheets look stable. But this same illusion has appeared before every downturn. Before the dot-com crash, profits were at record levels. Before 2008, companies were celebrating growth. Their margins started shrinking, layoffs began, and everything reversed almost overnight. If you look carefully at the numbers today, you'll see the cracks forming again. Profit margins remain high, yes, but they're starting to flatten. In many sectors, manufacturing, retail, transport, they are already falling. It's subtle, but it's there. When profits begin to tighten, companies respond the same way every time. They cut costs, and cost-cutting means layoffs. That's the danger zone we're entering now. The economy is still fragile from the shocks of the last few years. Savings are thin, debt is massive, and inflation has eaten away at purchasing power. The average American household has less financial cushion than at any point in the last decade. Businesses are stretched, governments are overextended, and the Federal Reserve, trapped between high inflation and slowing growth, has fewer tools left to fight the next crisis. That's what makes this moment so dangerous. The US isn't prepared, not financially, not politically, not psychologically. Everyone is behaving as if the worst has passed, but in reality, the pressure beneath the surface has never been higher. The stock market's rise has become a distraction, a comforting illusion that hides the weakness underneath. Because when you zoom out, when you look at 100 years of market history, you see that every major peak, every high point of confidence came just before a major downturn. 1929, 2000, 2007. The pattern repeats. The catalyst changes, but the psychology doesn't. The moment everyone believes the system is invincible is the moment it breaks. And that's where we are again. The event that just happened, the rise in tariffs, the renewed uncertainty in global trade, the quiet slowdown in hiring, may seem minor now, but it's the spark that lights a long fuse. The economy doesn't collapse in a single day. It erodes slowly, invisibly, as confidence drains away. And when the breaking point finally arrives, it feels sudden only to those who weren't paying attention. The signs are already here. The rise in unemployment, the fall in leading indicators, the tariffs cutting into trade, the businesses hesitating, the consumers stretched thin. Each one alone looks manageable. Together they form a pattern that history has always recognized. The US isn't prepared, not because it lacks data or warnings, but because it refuses to believe them. It's easier to celebrate market highs than to face what's underneath. It's easier to believe that this time is different than to admit that cycles always return. But the truth doesn't care about optimism. Right now, the economy is balancing on the edge, strong enough to stand, but weak enough to fall with one wrong move. Maybe it's another oil shock. Maybe it's another wave of tariffs. Maybe it's something no one sees yet. Whatever it is, when it arrives, the system will not have the flexibility it once did. In the past, the Federal Reserve could lower rates, print money, and restart growth. But this time, inflation still lingers. Debt is enormous. Stimulus might not work without igniting new problems. That's what makes this situation unprecedented. The usual tools may backfire. So what happens next? The most likely outcome is gradual deterioration, the kind that looks calm until it's not. A few weak job reports, a dip in profits, a correction in the stock market, then a wave of layoffs, then panic. Each step feeding the next until the illusion of stability vanishes. And when that moment comes, people will look back and say the same words they always do. No one could have seen it coming. But the truth is, the signs were here all along. They always are. Smash that subscribe and like button. Let me know your thoughts in the comments. And I also want to remind you that if you want to build a YouTube channel like the one you're watching now and make money from it, I opened a free Telegram community with the link below. See you there or in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.